Okay, welcome to Next Gen Professional Associates. In today's class, we shall continue with absorption costing, right? In our previous lecture, we were able to derive the profit, the gross profit using absorption costing, right? Then in today's class, we will continue from there, which means that we need to calculate the over absorption or the under absorption. Don't forget that in our last class, I've explained that over absorption, over absorption will be added to your gross profit, while your under absorption will be what? Will be deducted from your what? From your expense, will be added to your expenses, which will be deducted, which will be used to reduce your what? To reduce your income. Don't forget that absorption costing is just like profit or loss account, right? You can see we have the gross profit, the over and under, we have the expenses as well. And I've equally explained why we have to put variable from our format. I've equally explained that why we have to put a variable selling production overhead as an expenses. I said it is because variable selling, it is charged to sales. The expenses you incur in selling that product, it becomes your what? Your expenses under the what? Under the marginal costing, right? So, and we have the fixed selling overhead, right? Now, how do we determine the over absorption or under absorption? How do we determine the over or under absorption? Let's quickly scroll down. Now, for you to get your over or under absorption, right? Now, your actual fixed production given to you in the question, or your actual fixed production, then you have your overhead absorbed. Your overhead absorbed is calculated as OAR. OAR means overhead absorption rate, right? Times, we've actually explained all this in our previous class, times the actual production, right? Now, if this is established and this is your overhead what? Overhead absorbed. Don't forget that when your overhead absorbed is greater than the actual overhead, it becomes your what? It becomes an over absorption. Why the reverse is the case. Now, in this question, now let's quickly go to our question, right? Let's quickly go to this is the question here, right? Now, in this question, now we want to determine our over and under absorption. Ideally, when you want to determine your over and under absorption, you need your OAR, right? You need to get your OAR, which is overhead absorption rate. Overhead absorption rate is calculated as the budgeted fixed production overhead divided by the budgeted level of activity. Your activity level could be labor hours, could be machine hours, could be unit produced, right? Now, in this question now, the fixed production overhead, the fixed production overhead, which is the OAR that we are supposed to calculate, it is given already in the question, which is fixed production overhead cost per unit. So you don't need to calculate your OAR again. You will just pick the fixed production overhead, right? Then you move on. Now, if you pick this fixed production overhead as your what? As your OAR, is that also as your what? As your OAR. What do you use it for? You use it to multiply by your what? Your actual production. But the actual fixed production overhead incurred is not given in this question. Ideally, you're supposed to be given actual fixed production overhead to be this, right? So that is why I now say, oh, if that would be the case, for you to get your over and under, if that will be the case, now let's change the format. Let's change it. Like I said, there is no specific format, no specific rule. And I said that, oh, let's change it. Let's change it to be, or get your actual production. The actual production for January is 8,500. The one of February is 7,750. Now, the budgeted unit, it is annual. The budgeted unit is annual, right? And it is 96. If you look at it here, you can see that it is annual activity, right? Annual activity of 96,000 units. And don't forget that this is January and February, and this is for annual. You need to divide this by 12 so that you get the annual activity for each of the months. So that is why we equally divide it by 12. And this give us 8,000 and this give us 8,000. Now, from this part now, you can decide from this part that, oh, which one is over and which one is what? Under. Now, look at it. Look at it in this perspective. Don't forget is the cost, right? Now, they said you should budgeted unit is 8,000 units and you end up producing 8,500. Definitely you will spend more cost, you will incur more cost. That is an over absorption, right? The first one is what? Is over absorption. Over absorption. Right? The first one is what? Over what? Over absorption. Why the second one? Look at this second one. You said the budgeted unit is this, right? And the actual is it, that is an what? An under what? An under absorption, because it will be a cost to the firm because you did not actually produce what we say you should produce. So which means that what they budgeted for, who will use that cost? It will be a cost to the firm. That is why the under absorption is treated as what? As an expenses. So this one becomes what? Under absorption. Class, are we still together? Class, are we still together?
Yes, sir.
Yes, sir.
Okay. So now, if that is established, right? Now, you can see that this is just the unit. So what you now do now is, it is OAR. It is you use your fixed production overhead. So you just put your fixed, which is your OAR. You multiply it by OAR, fixed production. Don't forget that your fixed production overhead per unit given to you is your OAR, right? Overhead, right? Is your what? Is your OAR. OAR. So, and it is 3 naira, right? So you just multiply it by 3 naira, right? And you multiply this by what? By 3 naira as well. So please, what is the cost now? Please multiply what is the cost quickly, so that we can move ahead. Please quickly, what is the cost? Multiply, what do you have?
1,500. One
The first one is
five.
what? Okay, thank
One
you,
five.
Adiola. 1,500. Okay, next.
750.
500, right? Okay,
750.
750. Thank you. 750, right? Now, we've already established that the first one for January is over absorption. The second one is under. The reason why we have to do it like this is because we're supposed to have used this, but that is why I say there is no specific format for, for performance management. No, another person will tell you that no, you can do it this way, you can do it the other way. See, anyhow that you want to do it, just understand what you are doing. That is the most important thing, right? Now, ideally we should have used the actual fixed production. If the actual fixed production overhead is given in the question, fine. Then the overhead absorbed, how will you calculate your overhead absorbed? I've explained in my previous class, but let me see explain to you again. Now, the overhead absorbed, right? is just like your budgeted unit, your budgeted cost. See, you will appreciate absorption costing when we get to variance analysis, right? When we get to where? Variance what? Variance analysis, right? Now, you will now do what? Your overhead absorbed will be calculated at OAR, which is how will you determine your OAR, overhead, the basis of absorption. Don't forget, in the material, I listed the basis of absorption, right? It could be on labor hours, it could be on machine hours, it could be on unit, it could be on percent, it could be, company can absorb their overhead on different what basis. You multiply it by the actual production, and I've explained the reason why you have to multiply by the what actual production in our what in our previous lecture. Now, and that is it. Now, which means that we quickly go back, and say, since over is 1500, we go back to over is 1000. Let me remove this. Over is 1000, 1500, right? Why the under? Okay. Why for January? For February, don't forget that for February is under, right? Is under. So which means that under will be treated as what? Will be treated as your what? Your expenses class. Will be treated as your what? Your expenses class. So which means that your total income here, please add 113,000 plus 1,500. So you just bring this one down as your 166 250. You bring it down, right? As your total income.
134,500.
Okay, 134 500, right? 134 500. So if this is your total income, right? If this is your what? Total income, right? If this is your total income, you can now continue from your expenses, right? Now, in this your expenses, right? Is there any variable selling production overhead given in the question? You can see that in this question now, we've read this several times. The variable production, the variable selling, where is the variable selling said? The variable selling is given. Don't forget that this variable selling is an expenses under the absorption costing. Why? Because these are the expenses you incur when you want to sell, that particular what, that particular product. And that is why it is an expenses under the absorption costing. You can treat it as non-production cost under marginal costing, which we have examined that in our previous lecture, right, class? So that is why you have to bring in your variable. You can see it here, your variable selling. You can see the variable selling overhead is 15 naira per unit. It is selling. No, don't go and multiply by production, class. It is selling. Now, it is 5 naira per unit. So now you can see the sales for each month, 7,000 and 8,000 what? 8,750. So you multiply your 5 naira per unit times the 7,000 for January times 8,750 for February. Now let's go there. Now we can have the variable selling now is 3 naira, right? Please confirm if it is 3 naira. It's 3 naira, right?
5 naira, 5.
Okay, 5 naira. Thank you. Okay, thank you. Now, what is the sales for January? What is the sales for January times the sales unit? What is the sales
7,000. 7,000.
for January?
Yes.
Okay, please, someone else should confirm that. Times
Correct.
sales. Okay, thank you. So we move on. Please multiply. So let's get our variable. Let's get our. Let's quickly get.
35,000
What do we
for
have?
January.
What do we
35,000
have?
for January.
35,000.
35,000.
Okay, 35,000. Okay, thank you. So we quickly check for February as well. You multiply 5 naira, right? 5 naira, right? times. So what is the sales unit for February? What is the sales unit for February? Quickly. What is the sales unit for February?
43. 8,750.
8
8,750.
8,750, right? It is given in a question. If you have your material, you can check. It's there, right? It's there. So you can as well check here. You can see it here as 8,750 for sales, right? Now, so multiply it. What do you have? Multiply what do we have? What do we have? 43,750. Okay, good. So what next? Variable selling, right? We have the variable selling. Variable selling is also given in a question. Is an expenses, right? Variable selling. Please don't come and add your variable production overhead again, no, because you have used the variable production overhead to determine your over and under absorption. It's only expenses that you bring in class. Now, the variable selling, right? The variable selling is based on sales, is sales, not production, is sales, is sales. You multiply these 2 naira times sales class. It is variable selling, right? Fixed selling, fixed selling. You multiply it by the what? By the sales, right? By the sales unit, because it is fixed selling, right? Which is what? 2 naira. So you multiply it. So we quickly come here and multiply it by 2 naira times 7,000 units, right? Times 7,000 units, please figure.
14,000.
Okay, 14,000. Sometimes all these things will be given to you in value, so you don't need to multiply again. So you just in this question is adopted from ACCA, one of the ACCA study texts, right? Now, the next one, you still check. Don't forget this as well. Is still 2 naira. 2 naira you multiply by the sales unit, which is 8,750, right? 8,750.
That's 17,500.
So what do we have?
17,500.
Okay, 17,500. Please, others should confirm that, right? Please confirm. So if this is established as well, which other expenses do we have given to us? We've done the variable
Fixed
selling.
admin overhead.
Okay, thank
Fixed
you.
admin
Fixed
overhead.
administrative overhead. You can see that this one is fixed. Fixed administrative overhead. Whether you produce, right? Whether you produce or you did not produce, you will incur fixed administrative overhead. Now, in this fixed selling, you can see that this is fixed selling. We multiply it by the sales. We multiply it by the what? This is fixed selling, right? Now, the fixed administrative overhead. Okay, administrative, fixed administrative what? Fixed administrative overhead. Please give me a figure. What do we have there? Class, are we still together?
3 naira times.
Okay.
3 naira times
Now,
7,000.
3 naira time. So you can agree with me that this your fixed selling overhead is wrong. This your fixed selling overhead is wrong. Class, your fixed, let me quickly say this again. I've been saying it, right? I just quickly look at it. I say, this is fixed selling overhead. Fixed means it does not varies, it does not change. See, whether you produce that unit or you did not produce that unit, you must do what? You must incur that particular what? That particular cost. It is not based on what you produce or based on what you sell. Class, it is not based on what you produce or what you sell. It is based on what we have already fixed that, oh, this is what we fixed for it. Don't forget that what they fixed for the unit is 8,000. It is 96,000 units. Is that not so? They fix it as 96,000 units for annually. Is that not so? And for each of the months, you divide it by 12. You have your what? 8,000 units. You can see, because if you use 7,000, what it means is that your fixed selling overhead varies with the levels of sales, which means that when you have 7,000 sales in January, you have 8,750. So therefore, your fixed selling overhead varies. That is what it means. That is what it means, which means that it's wrong. Your fixed selling overhead should be fixed, whether they produce that unit or not, or whether you sell that unit or not. It's supposed to be what? The same, because fixed selling overhead cost is what? Is fixed. So therefore, we are not supposed to multiply by what? 7,000 units for the fixed selling overhead as well as 8,750, because it's supposed to be what? Fixed. So therefore, you can change it to 8,000 units, class. So this one is 8,000 units. Don't forget how we get our 8,000 units to 96,000 units divided by 12. Is that not so? Divided by what? Divided by 12. So what do we have here, please? Before we continue, please, what do we have here? Multiply it. What do you have?
16,000.
Thank you. 16,000. What do you have here? What do we have
Same
here?
16,000.
Okay, you can see that. Thank you. 16,000. Thank you. Thank you. So now, if that is established, so we have fixed administrative, right? So what is the cost? What is the cost? What is the cost? Quickly.
3 naira.
3 naira. So this one is also fixed. Whether you produce or you do not produce, you will incur this cost, right? 3 naira. So what do you have here?
24.
Okay, you have
24.
this. Okay, 24,000. You still have the same 24,000, unless if the per unit fixed administrative overhead per unit changes in February, right? Right. Don't forget that your fixed cost per unit, varies. It is just the total fixed cost, right, that remain fixed. Don't forget, we under the what? Under the cost estimation. So this will be what? 24,000, right? Now the last one is we've done the over and under absorption. That this one has what do we have here as the under absorption set? What do we have here as the under absorption? So it's
750.
750. Yeah, right? 750, class. We have 750, right? For it is not for it is for February, not for January, right? Okay. 750, right? So you can put less. You can put less expenses here so that you know that you are deducting it from there. You can put less expenses. So please, class, what do you have? Remove your total income minus the expenses. Someone should give me for year one. For February, the other person should give
For
me for
January. For January, 59,500.
59,500.
59,000.
Okay. So why for February? What do you have for February?
81,
Why for February?
750.
81,750, right? And this is all about the question, right? The question says that using the marginal costing, determine the actual profit. Using the absorption costing, determine the what? Determine the profit statement using the what? The absorption costing, of which we've been able to do that in this question. Don't forget that the question still went further and say reconciliation. Of course, the reason why the profit for marginal costing is different from the profit of absorption costing. It is because of the difference in what? In the valuation of the inventory. You can see that in the valuation of marginal costing, you use variable cost. While in the valuation of absorption costing, you use what? Full cost. And these are the reason why their profit statement will be what? Will be different from each other. Of course, now we now move to reconciliation. So when you are doing something like this, how will you reconcile the profit of marginal costing with the profit of absorption costing? Which means that when you start with profit as per marginal costing, you must get your profit as per what? Absorption costing. So what we will use basically is the differences in what? Is the differences in the what? The opening inventory as well as what? The closing inventory of both marginal costing as well as what? Absorption costing. So Ibrahim, you can ask your question.
Okay, thank you very much, boss. Okay, my question before you move on, my question is how do you go that 8,000 units under 15 overhead and 2,000 overhead? How do you go to
Um,
8,000 units?
Ibrahim, have you been following us? You've been following us, Abi? Have you checked the videos? You've been following us? Have you been following us on this
Yes, yes,
question?
sure,
But we've been
sure,
using
sure,
this
sure.
8,000 naira, 8,000 units. We've been using it, right? Go back to your question where they tell you that I will divide it so that you see. Where they tell you that the normal annual activity level is 96,000 units. This is for annual, and you have to prepare for January and February. Right? You need to do what? Divide it by 12 so that you will get for January as well as you will get for what? For February. And that is why we get that 8,000 naira. Go and check your, even go and check your, if you check your marginal costing, where is it? If you check your marginal costing suggested solution, where is it sef? This is it, right? We equally divide it. I even put it there that divided by, you can see it under the fixed administrative overhead divided by 12. So that is why I asked you that, have you been following us in this question? So I don't expect you to ask that question, but it's
Thank
fine.
you very much.
Well done. It's fine. So do we have any other person that want to ask question? Before we continue, we proceed to reconciliation. Please unmute your mic and ask question. Question? Don't forget that I've explained that absorption costing is a traditional approach or a conventional system. Because the question may say, oh, using the conventional approach, determine the overhead. You now say, which one is conventional? Which one is traditional? It is an absorption costing, right? Right? And that is it. So if you have question, unmute your mic. Please, if you have question, unmute your mic before we
Sorry.
continue, please.
Another question, sir.
Okay,
Another question, sir.
go
Okay,
ahead.
for that question that you mentioned, traditional, I did the same thing.
What?
This is the same thing with conventional and
Yes,
traditional
yes.
question that you mentioned.
Yes, yes, yes. You know, you've equally asked this question in our previous class. You can see that I can still recall. You asked that which one is when I was defining when I defined the absorption costing that is a traditional or conventional costing technique. You asked that question. Yes, right. Absorption costing is also known as traditional or a conventional system. Right. Any other question, please, before we move on?
Thank you very much.
Yeah, you're welcome. Any other question? Okay, that means we can move ahead, right? Now is reconciliation. I've equally give reason why it is a traditional approach, right? I've equally give reason why it is a what traditional. Please, who can assist us? So if you know it, right? I think you have gifts, special gift. Just send me DM. If you get the answer, you just send me DM. You have a special gift. Why do we have to call it a traditional costing approach or a conventional costing approach. Why? Give practical reasons. Reason. Who can try?
Let me try.
Okay.
Hello, good evening.
Yeah, I'm with
So the
you.
reason
I'm
why
with you.
absorption costing is called traditional or conventional approach is because it is a technique that is used to ascertain costs. And since we know that absorption costing, another word for absorption costing is full cost, it is charged on both fixed and variable costs to production. Thank you.
Okay, good. Well done. Well done. You try. You try. Interesting. Now, another point is that why is it like that is because for long show we are four. There are four. What is it called? Four units. We are the numbers of people in Oshodi Limited. Maybe the plaza, right? The plaza. There are four. There are four shops, and NEPA now bring bill that, or water board bring bill that, oh, this is it, oh, it is 15 naira. Oh. Now, Afolonso will now say, oh, let's divide it by four because we are four, it is four shops, right? And we now share it equally. And that is what absorption costing is doing. And it is totally wrong. Why? Because it is not based on what you consume. It is based on equally. That is wrong. That basis of absorption is what is wrong. It's cheating. Thank you. That is the reason why activity-based costing now came into an existence to replace the traditional approach. Don't forget that when you want to determine your OAR, how do you determine your OAR? You say budgeted overhead over budgeted levels of your activities, right? Which is your OAR. You now do what? You multiply by the actual production. And that is what activity-based costing, well, that is what absorption costing is doing, right? Which is totally wrong. Why? Because you will not know the cost of each or the cost that you incur to each of these stages of production. You will not know it, right? You will not know it. And that is what activity-based costing came into an existence to correct. That we want to know the cost of everything you incur in production. Absorption costing just charge everything directly to the production, right? Both fixed cost and variable cost, which is wrong. You will not know the cost you incur in every stages. You can say that performance management is interesting, is your understanding that will give you what you want, right? And that is what we are doing at Next Gen Professional Associate. Now, let's quickly move ahead to reconciliation, right? I hope we get that. Do we get that? Hello? Are we still together?
Yes, sir.
Yes, sir.
Okay, that's fine. So now, let's quickly move to memorandum reconciliation. Let's quickly do reconciliation. Don't forget that what make the profit of absorption costing to be different is because of the difference in valuation of their inventory, right? So, and that inventory of opening and closing inventory, that is what we will use for the reconciliation, right? So, if you start with profit as per absorption costing, you end it with what? Profit as per what? As per marginal costing, right? Reconciliation. Now, we want to do reconciliation, right? So, if we want to do reconciliation, if we start with profit as per, if we start with profit as per marginal costing, you end it with what? Profit as per what? Absorption costing. Now, what make the profit to be different is because of the differences in what? In the valuation of inventory, right? And that that is what we will use to reconcile the two. Class, are we getting the gist? Right? And that is it. Now, which one are we starting with? Should we start with profit as per absorption or profit as per marginal? Class, January, February.
Let's start with
Class,
marginal since you did marginal first.
okay, oh, thank you. Now, profit as per MC. Don't write MC in exam. Oh. See, MC means MC. Oh, no. See, those, sorry. MC can mean anything, right? Please don't write MCO. Now, what is the profit for January? Quickly, someone should just give me figure and let's move on, please. Figure. Profit for January and profit for February. Quickly.
55,000. 55,000 for January.
55,000 for January. Okay. For February,
84,750.
84,750, right? Now, we'll now go into the valuation. We'll start with the opening inventory. Opening inventory class. Now, don't forget that there was no opening inventory in January, right? Don't forget that in the two, there is no opening inventory in January, but there is opening inventory in what? In February. Is that not so? There's opening inventory in what? In February. Is that not so? So now, in this case now, you now come and say, there's a logic here, right? Please, I want you to understand the logic, right? Now, the logic here is that if you are starting with profits as per marginal costing or profit as per absorption costing, now you will now state it this way. If the opening inventory, since you are starting with marginal costing, if the opening inventory, right, of marginal costing is higher, is greater than absorption costing, right? What do? You add the differences. You do what? You add the difference, which means that if for marginal costing is 20, absorption costing is absorption costing is 10. The difference, you add it to your profit. That is what it means. Let me repeat that again. Excuse me. If your opening inventory of marginal costing is greater than absorption costing, you add the difference. When you look for the difference, you add it to the profit. But if it is lesser, the difference is you do what? You subtract the difference. It's just like plus and minus class. Let me repeat it again. If your opening inventory, you are starting with marginal costing, for instance. If your opening inventory of marginal costing is greater than absorption costing, right? You do what? You add the difference. The difference means that if opening is 50 for marginal costing and the closing and the for absorption costing is 10, what is the difference? 14 naira. You add it to your profit. But if it is lesser, right? You subtract the difference from your what? From your profit, class, and that is it. That is the logic. Plus and minus, class. Plus and what? Plus and minus, right? Now, let's go there. So now, let's now check. What is the opening inventory? What is the opening inventory of marginal costing, class? What is the opening inventory? Let me quickly go there. Opening
No opening
inventory for
event.
February. Okay, for February. You know, there's no
Okay.
opening for February. Yeah, for
34,500.
February. Where is it? Where is it? Where is it?
34,500.
Okay, this is it. 34,500, right? Please ensure you go back, download it, watch, blah blah blah. Then put what is relevant to you. 34,500, right? Minus what is the closing inventory? You know, we did not have for January. That is why I didn't bother for January. So what is the closing inventory? What is the closing
39
what is the
for
opening
February.
inventory of,
For
yeah, for
February.
February? So what do we have? For absorption, what do you have?
39,000.
39,000.
39.
39. Let me quickly confirm that. Let's go there. Let's go and confirm. Absorption. Where is the absorption? Opening inventory. What is the cost? Let's quickly go there. Oh, it's 39. You can see it. It's 39,000. Okay. So any other figure you give me, we are good. We are good. It's just opening and closing. So check. You can see that, look at it now. The 34,500 is for marginal costing. Don't forget the statement, please. Don't forget the statement. If the opening inventory of marginal costing is greater than absorption costing, you add the difference. But if it is lesser, you subtract the difference from your what? From your profit. Please, class, what is the difference between 34,500 minus 39,000? Quickly, what do we have?
4,500.
4,500. You subtract it, right? 4,500. Because we must arrive at what? Profit as per absorption costing. We must arrive at profit as per absorption costing. Now, if this is established, we did not have for opening for January. So you still do closing, because what makes the differences is because of the opening, the valuation of opening and closing inventory. Now, excuse me. Now, don't forget that opening inventory is plus and minus, right? Plus and minus. Now, closing inventory will be minus and plus. How do I put this? Okay, let me just put it this way. Minus this. Okay, will be minus. Let me put it this way: minus and plus. Now, we now go there that if the closing inventory, right, of marginal costing is greater, if the closing inventory of marginal costing is greater, what do you do to the difference? You subtract the difference. That is why I say it is minus, because you are starting with marginal costing. If the same thing, if you are starting with absorption costing, if the closing inventory of marginal costing is higher than absorption costing, you subtract the difference. You subtract the difference from the profit. You do what? You subtract the difference from the. You say, who is that?
I said, can you come again, sir?
Okay. If this, you see this minus and plus, you can see minus and plus. Minus and plus means that if your closing inventory for marginal costing is greater than absorption costing, you do what? You subtract the difference. That is why I say minus. You subtract the difference from your profits. But if it is lesser, you add the difference. That is why I say, you can see plus, you add the difference. It's just like opposite of opening. When I say when it is greater, you add. When it is lesser, you subtract. Closing, when it is greater, you subtract. When it is lesser, you do what? You add. Class. Now, give me the closing inventory for January. For January, what do you have? For marginal costing?
34,500.
Okay, 34,500. Minus, what is the closing for January under absorption costing?
39,000.
Absorption, 39,000.
39.
Thank you. Now, you can see that I said 34,500 is marginal. 39,000 naira is what? Absorption. Now, the law says that if 34,000, let me put it, 34,000, this is MC, right? MC. This is AB, which is absorption costing. Now, if the closing inventory of marginal costing is greater than absorption costing, you subtract the difference from your what? From your profit, right? But If it is lesser, you add it, you add it. Now, look at it now. The marginal costing, the closing inventory of marginal costing is lesser. It's not greater. Is it greater? No, it's not greater than absorption cost. It is what? It is lesser. What the law says is that you add. That's why I say plus. You add the difference. Class, what is the difference? 4,000 what? 4,500. So you add the difference to your profit. So the same thing here. What is the closing for February? What is the closing for February? What is the closing for February?
Closing for February is 11,500.
11,500
Yeah.
for absorption for marginal costing, right?
Yes.
What of for absorption costing? Closing. What is the
13,000.
closing? 13,000. Thank
13,000.
you.
Yes.
Thank you. Now we still go by the law again. It's still the same law. MC. This is the first one is MC because you are starting with marginal costing. This is AB. How many minutes? Let me check. Oh, 9 minutes. Okay. Now, if the closing inventory of marginal costing is greater, you subtract the difference. But if it is lesser, you add the difference. Now, when you look at this now, which one is greater? Which one is greater? Which one is greater? The profit, if the profit
Absorption.
of, thank you, if the profit of marginal costing is great, if the closing inventory is greater, the closing inventory here is 11,500. 11,500 is lesser. When it is lesser, you add the difference. Please, what is the difference? Quickly, what is the difference? 1,500. So we will now say your final figure will be profit as per absorption costing. Absorption what? Costing. Class. So please add January. What do you have for January? Add it. What do you have? For
59,500.
January, what do you have? 59. Do we arrive at the same? Do we arrive at the same profit?
Yes.
59,500. So add and subtract this. What do you have?
It's 1,750.
It's 1,750. Do we arrive at the same profit? Do we arrive at the
Yes.
class? Do we arrive at the same profit or we did not arrive at the same profit?
We
Are
did.
we together? Okay. And that is
Yes.
why there is difference is because of the valuation of opening and closing. That is why there is difference in what in their profit, right? You can see that when you look at the absorption costing that we calculate, it is 59,500 for January. It is 81,750 for what? For February. And this is what? This is a reconciliation, right? Distinguished professional colleagues, performance management is very, very simple. And that is why we are breaking it down so that you will understand. You go and watch the video again so that you have more understanding of this, right? Now, there are questions in the what? In the material. Now, the one of year 1 and year 2, I think I did a pre-recorded video for the one of year 1 and year 2 on absorption costing. So you will do the one of marginal costing. So others too, you will, I swear, you will attempt it, right? You will everything is for you will attempt it. If time permits us this night, we can look at one of the questions in the material, right? Okay, Ibrahim.
Okay, yeah, thank you very much, boss. Please, concerning this opening inventory, I want you to emphasize more on it, like you do for closing inventory.
Okay. I've done that before. Thank you.